This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.
Cross-current stocks steadied after yesterday's big sell-off, but are there cracks forming in some key areas of the market?
Out of options, Sears once dominated retail. Now it's unsure whether it can stay in business.
Locked out, why prospective buyers are having a hard time becoming homeowners. Those stories and more tonight on Nightly Business Report for Wednesday, March 22nd.
Good evening, everyone, and welcome. The focus today was back on fundamentals, things like bond yields, the oil market, and a transportation business, which is the backbone of American commerce. But not all investors liked what they saw, and that lack of enthusiasm translated into a bit of a tug of war on Wall Street. The Dow Jones Industrial Average off 6 points to 20,661. NASDAQ, however, rose 27, and the S&P 500 gained 4. The focus on domestic markets was so strong that investors shrugged off the deadly attack outside British Parliament, an attack police are treating as terrorism. Dominic Chu takes a look now at the market's fundamentals and where some cracks may be forming.
The stock market weakness recently highlights a few of the points and concerns that traders and investors have about what's happening in the overall marketplace. And there are a ton of them out there to talk about, but let's narrow them down to 5 big themes that we have going on for why at least some investors are concerned about what's happening with the recent Trump rally and the weakness that we've seen as of late. First of all, you've got Treasury yields. That is to say, the interest rates on U.S. government bonds. They are moving lower, which means that people are buying up the safety there. If interest rates keep on falling in this way, could it be a sign that people want safety as opposed to perhaps the risk and return of stocks in the marketplace? That leads us to bank stocks. Bank stocks are heading lower and took a big hit in the recent downturn. One of the big reasons why is because as these interest rates start to move lower, profitability at banks could suffer. So when banks make less profits, maybe those stocks go down pretty hard. That's the bank stock side of things. Small capitalization stocks. The Russell 2000 index is now flirting with negative to just around flat territory right now. Small cap stocks seen as a leading indicator for what happens in the overall market. If there's weakness there, maybe it spreads. Another place to watch, transportation stocks, trucking, rails, airlines, that sort of thing. If these types of stocks aren't moving around as much to the upside, it may mean that people aren't shipping as much and maybe economic activity is slowing down a bit. That's the reason why people care about this one here. And then finally, let's talk about oil prices. We've seen pain at the pump go away a little bit recently. Oil prices have fallen. With energy stocks, though, it's all about whether or not we see that oil trajectory continue lower. Oil stocks had been a bright spot over the course of the past year as those stocks started to stabilize. But again, 5 of the bigger themes, of course, there are many more out there, but these encompass some of the reasons why traders are worried in this recent stabilization/downturn in the market. For Nightly Business Report, I'm Dominic Chu.
And according to the latest Bank of America Merrill Lynch Global Fund Manager Survey, a record number of professional investors have their concerns about the market as well. Michael Hartnett is the Chief Investment Strategist with Bank of America Merrill Lynch, and he joins us to talk more about the study. Welcome, Michael. Nice to have you here, as always.
Hi, how are you doing?
Good. Let's start, first of all, with some of the findings of this survey. And I was struck that you say a record number of investors, 34%, the most in 17 years, find the market overvalued. That's a pretty stunning statistic.
Yeah, it is. I mean, the market is, after all, at an all-time high, or was very close to an all-time high. So it shouldn't perhaps be too surprising. But nonetheless, I think it does reflect the fact that while people are very bullishly positioned, they want to be in the market, they're they see the price action forcing them in. They've got this one big nagging sort of worry is that things, are not cheap. But they've also got this problem of where do they go, because
Right.
bonds aren't cheap either. So it's a real reluctant bullishness that you have coming through.
But speaking of bonds and interest rates, I note that the one thing above all of the other factors that these investors think could bring the end to the equity bull market is rising interest rates. Tell me about how pronounced that feeling is and what is the level at which they think interest rates could slay the bull.
Well, they fear the central banks, but in a very small way at this moment. That may be wrong. I mean, after all, last week may have been a very important week in that we started to see the first sort of synchronized tightening of monetary policy around the world. The Americans went, the Chinese went, the Europeans and the Brits sort of hinted at tightening. So, I think these fears are going to grow. Right now, however, they're saying, look, unless you get a 10-year Treasury yield that exceeds 3.5%, we're going to be okay. And any increase in interest rates that you see is probably going to be a good increase in interest rates rather than a bad one.
You mentioned the fact that, they do have to, these are professional investors. They're managing money for other people in many cases, and they have to deploy that cash. Are they looking globally? Because as our graphic just indicated, the U.S. market seems to be the most overbought. Where are they finding opportunity?
Very much so. I mean, that has been the story over the last couple of weeks, maybe a month or two, is that what you're not seeing is the professional investors basically say goodbye to the equity market or goodbye to the U.S. equity market. They're basically saying, look, U.S. stocks look very, very rich. Let's go overseas. Let's look at Europe. Let's look at Japan. This month, we actually saw some rotation towards emerging markets. So you're certainly seeing an equity story that really, from a positioning perspective, is one of rotation rather than a major reversal.
When did you take this survey? I'm just curious, and that's question one. Question two is, what are they doing with cash? Are they deploying it, hoarding it, raising it?
Well, cash is one of the most watched indicators from this survey. It's a survey of about 250 investors all around the world. It's got a great history, a very good track record, and basically the survey ended, I think, late Thursday last week. So it's very recent. Instant snapshot, basically, of what positioning is. Cash is really one of the things that people watch a lot, simply because it's got a great track record in terms of market timing. When you see cash below 4%, that equals greed. You want to lighten up. When you see cash above 5%, that equals fear. You want to buy. The figure last week was 4.8. It's coming down, but it's not yet at the levels that say you've got to get out of the stock market.
On that note, Michael, thank you so much. Great information.
Pleasure.
Michael Hartnett with Bank of America Merrill Lynch.
Investors are watching the drama unfold today on Capitol Hill, where a House vote on health care is expected to take place tomorrow. The Republican bill faces stiff resistance from members of the Republican Party. The chair of the House Freedom Caucus said conservatives' opposition to the legislation is strong. That raises doubts about the legislation's future. As we've been reporting, Wall Street is growing concerned that a delay in health care reform could slow the administration's ability to push through pro-growth policies like tax reform.
The proposed border wall is another controversial issue in Washington, and it appears as if the backlash among some lawmakers is growing. Ilan Mui is in Washington tonight. Good to see you, Ilan. And how are state and local officials trying to stop companies from participating in building the wall?
Good evening, Sue. Well, there are really two ways that state and local officials are looking at this. One is to ban companies that bid on the wall from receiving local government contracts. So that's number one. Number two is they're trying to pass legislation that would prevent public pension funds from investing in companies that have bid on the wall. Some of the states that have been looking at this are California and New York, and some of the cities that are involved are New York City, San Francisco, Oakland, Berkeley. These are some of the places where we really start to see this backlash over the border wall starting to grow.
Have we seen laws affecting the pension fund's investment strategy passed like this before, and what has been the effect of that?
Where you've really seen it in the past is around tobacco, for example. So CalPERS, which is the public pension fund in California, one of the largest in the country, they recently decided to remain divested from tobacco companies. They're not going to invest in those companies because they do not feel sort of socially, ethically, morally, it's the type of investment they want to have. However, what the funds say is that it's important to remain engaged in the company's rather than divest fully, because if you pull your money out of a company, you no longer have influence over the company's decision.
Very good point. What is the status overall of the border wall? Bring us up to date.
Yeah, so we saw the first federal dollars being requested for the border wall, about $4 billion over the next 2 years. And the government has put out its official request for proposal in building the border wall. They're looking for a 30-foot wall made of concrete and perhaps some other types of fences or non-concrete structures as well. So we're starting to see real money and real details around how this would get built.
Ilan, thank you as always. Ilan Mui in Washington.
Also on Capitol Hill, President Trump's nominee to lead the Labor Department testified at his confirmation hearing. Alexander Acosta said jobs should not be a partisan issue and pledged to work with Congress to help workers gain access to training.
It was crystal clear that every member of this committee wants Americans to find jobs, good jobs, safe jobs, even if you don't all agree on the how. I share this goal with you. We may not always agree on the how, but at least let us begin by agreeing on the need.
If confirmed, Mr. Acosta said he would enforce labor laws fully and fairly.
And investors are also watching the Federal Reserve and the direction of interest rates. Today, the president of the Dallas Fed said he expects 3 interest rate hikes this year. Robert Kaplan cited a near fully employed workforce and inflation close to the Fed's target at 2% for his outlook. He added that he's also watching the healthcare debate unfold in Washington because it could impact consumers' willingness to spend.
Sales of existing homes fell harder than expected in February after hitting a decade high the month before. It's not because of lack of demand. Buyers are out, but there are obstacles in their way. Diana Olick has our story.
Home shoppers out this spring are finding fewer listings and higher prices, and both are standing in the way of sales. February was the warmest in half a century, but sales chilled, falling hardest in the Northeast and only managing a small gain in the South.
Here we have our master suite.
Realtors say they're seeing far more potential buyers, but not even close to enough listings to meet the demand. Supply is down over 6% from a year ago and has been falling now for nearly 2 years. Why? Well, for one, builders are only operating at about 70% of their normal production levels. They blame a lack of land and labor, as well as the rising cost of regulation, for their slow and wobbly recovery.
What we're seeing is actually the share of new homes that comprise of all home sales is, only about 11 or 12% when it should be about double that. It should be about 24%. And normally, that might not raise much of an eyebrow, but that should raise eyebrows now because existing inventory and existing home sales is also still pretty low.
But it's not just the builders. Following the housing crash, investors scooped up bargain basement distressed properties, adding 4 million single-family homes to the rental stock. With rental demand still very high, they're not selling them back into the market as some had expected.
Investors came in to get that cash flow, and the cash flow remained very positive, and the price appreciation is just extra gravy that they are witnessing, and they are saying they're going to ride out these price increases.
Not only are investors not selling, they're buying more, and they're using cash to do it. That leaves regular mortgage-dependent buyers, especially first-time buyers looking for a good deal, locked out. For Nightly Business Report, I'm Diana Olick in Washington.
Still ahead, hard times. Sears used to be a retail star. Now it's losing billions, and even the company is raising questions about its future.
Sears and Kmart, they're famous American brands that are staples in malls across the country. But after years of mounting losses, the retail company issued a dire warning about whether it will be able to keep its doors open, saying that it has, quote, substantial doubts about its future. Don't hear that every day. Shares plunged down more than 12%. Courtney Reagan takes a look at what might be next for Sears.
It's no secret Sears' heyday has long passed. The 124-year-old department store hasn't acknowledged the extent of its trouble, though, until now. In its annual report, Sears admits, quote, "Our historical operating results indicate substantial doubt exists related to the company's ability to continue. It's a going concern." Results that include losing nearly $10 billion in 6 years and sales that continue to plunge quarter after quarter, now with just 40% of the sales it had at its peak a decade ago. Ted Stinger is a retail consultant specializing in restructuring, but he was the treasurer at Kmart shortly before Sears and CEO and hedge fund manager Eddie Lampert bought it 15 years ago.
At this point, they haven't put anything on the table that would make outside stakeholders like the vendor community comfortable that the next year is going to be one where their exposure to Kmart and Sears is not a significant negative exposure.
Sears has undertaken complicated financial engineering to fund the business, thanks largely to financial support from Lampert and his hedge fund ESL. Lampert owns both the majority of Sears shares and its debt. Sears has borrowed cash from and sold bonds to Lampert's hedge fund, closed hundreds of stores, sold real estate and brands like Land's End and Craftsman. Still, some estimate that Sears will burn through almost $2 billion in cash this year and need the same amount to continue operating. While the retailer says it's taking actions to mitigate doubt about its survival, doubt seems to be exactly the market sentiment when it comes to Sears' future. For Nightly Business Report, I'm Courtney Reagan.
Discount footwear chain Payless is reportedly eyeing bankruptcy protection. The filing could come as soon as next week. The retailer could close as many as 500 stores as it and the industry as a whole try to adapt to the growth of online shopping.
Winnebago rides strong second quarter sales, and that is where we begin tonight's market focus. The company saw revenue spike 64% thanks to record shipments of RVs in the U.S. The company's CEO credited the results to growth in their towable segment. Shareholders were happy campers. Oh yes.
There we go.
Winnebago up 6% to $29.55. A New York judge ordered ExxonMobil to recover lost emails from an account used by Secretary of State Rex Tillerson while he was CEO. Tillerson and other executives of the company are under investigation for allegedly misleading shareholders about the risks of climate change. ExxonMobil shares down 7 cents at 81.76. AT&T said it's pulling its business from Google-owned YouTube over concerns that some of its ads may have appeared alongside videos promoting terrorism and hate. And Verizon piled on, saying it would also pull its ads. Google has been dealing with backlash from global companies over ads appearing next to objectionable content on YouTube. Shares of Google were down a fraction today to $849.80.
Starbucks says it plans to create more than 240,000 jobs globally by 2021. 68,000 of those jobs will be in the U.S. CEO Howard Schultz reiterated the company's social impact commitments.
I recognize more than any other time I'm here to serve our shareholders and at the same time work with like-minded CEOs and elected officials to try and move the country forward and address the needs of millions of Americans who either are not in work, not in school, and really facing challenges that require a more compassionate understanding of the people who don't have a voice.
Shares of Starbucks rose 35 cents to $55.89. After the bell, the discount retailer Five Below posted better than expected fourth quarter earnings. The company also said it plans to open about 100 stores this year. Shares of Five Below initially rose in extended hours trading following that news, but ended the regular session down nearly 2% to 38.13.
A technical glitch at the New York Stock Exchange wreaked havoc on hundreds of electronically traded funds, ETFs, earlier this week, affecting those with market values of more than $150 billion. But with the ETF industry clocking in at a whopping $2.6 trillion in assets in the U.S. and more than $3 trillion globally, will the risks also grow? Ben Johnson is Morningstar's Director of Global ETF Research, and he joins us now to discuss. Ben, welcome. Good to have you with us. Is there anything that we really need to be worried about ETFs and their ability to be traded effectively, efficiently in the marketplace?
Thanks for having me, Tyler. What I would stress at the onset is that this issue is an issue not with exchange-traded funds, but an issue that's unique to the exchange and a software glitch that resulted from an updating of the closing price mechanism that was specific to the New York Stock Exchange. It did not affect ETFs traded on the other two major exchanges, NASDAQ and BATS, and is unique to ETFs because the ET in ETF stands for exchange traded. So coming with that exchange trading feature is a unique set of risks and responsibilities that ultimately present a burden and a learning curve for investors who have to know how to navigate the exchange trading function of these funds and how to do so safely.
And you make the point that there are a couple of things that people need to keep in mind in terms of when to trade the ETF, the beginning of the day and towards the end of the day. Tell me about that.
Absolutely. So following a few simple best practices, investors can all but immunize themselves from some of these risks. So avoid trading ETFs near the market open. ETFs are a basket of stocks. They take a while to wake up in the morning. They're a bit groggy when they roll out of bed because an ETF could account for 1,000 different individual stocks, and each of those 1,000 different individual stocks are going to open at different times during the first few minutes of trading. Also avoid trading near the close. What we see is that volumes tend to thin out near the close, bid and offer spreads tend to widen, pricing can be a bit more volatile. So if you avoid trading near the open or near the close, you can avoid many of these risks.
And of course, the other way you can avoid these trading risks is not to trade them, to buy and hold them.
Absolutely, Tyler. So the other bit I would add if you are going to trade is to use limit orders. Limit orders allow you to name your price, and you will get your price or better. Do not use market orders, which will subject you to the whims of the market. Do not use stop-loss orders, which become market orders at the worst possible time. And if you don't need to trade, if you don't want to trade, index mutual funds are a perfectly viable option for a huge number of investors. They will price at net asset value at the end of the day.
Ben, thank you very much. We appreciate it. Ben Johnson with Morningstar. Coming up, the art of the pitch, the most important 2 minutes of a startup's life. Global art sales fell to their lowest point since the Great Recession. According to a new report, sales of art and antiques dropped 11% to about $56.5 billion last year. That drop follows a 7% decline in 2015 and wipes out all of the gains from the previous 2 years. The report cites economic and political volatility for the decrease in sales.
Aspiring startups are looking for funding. Venture capitalists, they're looking for the next big thing. The two groups crossed paths in Mountain View, California. And as Aditi Roy reports, the pressure was on.
You just type your ideas in English, and an AI turns it into automated trading code on the spot.
In a standing room only auditorium at the Computer History Museum in Mountain View, 120 startup founders have 2 minutes to make the pitch of their lives.
We're going to make the internet so cheap, so affordable, and so accessible that every single one of those 800 million will be able to pay for it.
In the audience, 500 of Silicon Valley's top investors clamoring to find the next big thing.
I'm here to see the latest and greatest coming out of the Y Combinator batch.
Welcome to Y Combinator's Demo Day, the culmination of the Valley's preeminent accelerator program. Since its founding in 2005, Y Combinator has incubated more than 1,400 companies that together are worth $80 billion. Some of the program's most successful graduates include Airbnb, Dropbox, Stripe, and Instacart.
What you get from a couple days here is you get immersion in 100 ideas and how people are approaching it, how people are thinking, what new concepts are coming.
The batch in this round includes startups like Hy-Vee, which builds software for office management, Wright Electric, which is building an electric plane, and Fix, which calls itself the Uber of car repair.
The partners have essentially seen like thousands and thousands of the smartest minds in the world build outstanding startups.
Just to get here is an accomplishment in itself. 7,000 startups send applications for just 100 plus spots. The ones who make the cut spend 3 months in Silicon Valley developing their companies. Y Combinator CEO Michael Seibel says the immersive nature of the program is the key to its success.
What's different about Y Combinator is we put everyone together in a batch. And what that does is it makes everyone work together and help each other. And strangely enough, when you have a bunch of people working really hard next to you, you work even harder.
Seibel's 2 companies, Twitch and SocialCam, sold for a total of more than $1 billion, an endgame that these founders hope will someday be theirs as well. Y Combinator officials say some companies get funded right away, while for others, it could take months. For Nightly Business Report, I'm Aditi Roy, Mountain View, California.
Hy-Vee and Twitch.
Hy-Vee and Twitch. I wouldn't think of
Maybe
those
it's
names.
maybe it's a new sitcom.
It could be. That does it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Matheson. Feeling Hy-Vee. Have a great evening, everybody. We'll see you tomorrow.
Does that mean I'm twitchy?
Yeah.
Maybe it does.
Nightly Business Report has been funded in part by
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.